EduTrainer Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your EduTrainer National Insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your EduTrainer and coach for our EduTrainer Workshops, our introduction into annuities. And all this week we're doing annuity income. Unbelievable. Everybody is hot on this subject. It is the retirement planning issue of the day. Remember, all of our courses are built to be learned or to be actually viewed in chronology. So if you're just coming on today, you need to go back to the actual workshop 1 and go ahead and watch it in sequence. I think the tutorial works better and your learning experience will be great. And you say, well, Steve, I picked this up from the web. How can I find out all the additional shows? Well, they're always on our website, www.brokersalliance.com. As soon as you come to our homepage, you'll see the on-demand video button. You just click on it and all our EduTrainer workshops are listed right on our website in our archives, as well as our daily internet talk show, the Business Insurance Zone, and my opinion piece that shows up on the weekend, Welcome to the Weekend with Steve Savant. And any of the docs you see, hey Steve, I love the stuff you guys are using in your workshop, you say, I just identify it, write me, theBIZ at brokersalliance.com, and I'm happy to send it to you. That's theBIZ, THEBIZ at brokersalliance.com. Well, today I want to talk a little bit about how to generate some income, and we're going to be using, before we get to indexing tomorrow, we're going to talk about using combination annuities. And to show you this, I have a really great graph, and I highly recommend that you order it at theBIZ at brokersalliance.com, because to me, this is a good, solid, single page that maps it out not only for you, but I think it's really easy to understand with your client. Okay, we're on the Mondo pad looking at this basic concept, and again, you can order it, combination annuities. We're using this, what I call the traditional combination. Some people use the phrase split annuities, but I just like combination annuities. And the combination annuity in this graph shows two separate annuities. One's an immediate annuity, and the other one is a deferred annuity. Now, let's say we've been using this phrase, 150, I think I'm going to be using 150 in this example, but whatever you want to donate, you have yourself, and you're going to give a lump sum to the insurance carrier. And when you give the lump sum to the insurance carrier, they're going to split the difference and give you immediate income. And while you're living off the immediate income, the deferred annuity over a 5-year period in this example is going to accumulate and hopefully accumulate back to the original principal. So while I'm taking income, I only have to pay on the gain of the SPIA. I don't have to pay any of the taxes yet at the deferred because we're in the accumulation process. Of course, when I take any constructive receipt at all later on, I'll have to pay taxes on all the gain. But at this time, we're using the combination of immediate annuity and the single premium deferred annuity. Now, remember, under the section of the code, this is pretty important, section 72, it really talks about this issue that two contracts, annuity contracts are really, that are issued on the same person will actually be treated as one contract. So just be advised, you want to look at, maybe there could be some uncertainty here on the tax consequences, but we've been doing this for a long time, and so far the service hasn't said anything. But basically, I just want to give you the heads up for our disclosure purposes. You may want to look at that. And what I want to do now is give you kind of a hypothetical example of how to use an immediate annuity as well as a deferred annuity. Now in my example, again, I'm using a basic plan and I'm comparing it against a traditional CD. This hasn't been updated to reflect our interest rates, so the interest rates you're going to see here are actually quite outstanding and high and really not reflective of the market. Again, if you want to compare and actually plug these numbers in and use it every day, you might want to go out to bankrate.com, see what the period you're doing, in this case it's 60 months or 5 years, and go ahead and use those rates, figure out what those are, and then go ahead and plug them in. So what I've done in my hypothetical using an immediate annuity, a single premium immediate, and a deferred annuity, I'm going to be looking at it a 5-year difference. And right now, probably that 5-year rate's probably, I don't know, it's pretty low. That 5-year rate could be around 2 or maybe 2.25. But you'll want to look at this and say, in my example, I'm taking $150,000 and I'm putting it inside a CD. Every year, they're going to credit me, in this example, 3.5%. I wish. So they're going to give me that annual return, and I'm going to get that annual return. And when I receive that annual return, oh, and I'm sorry, it's 6 years, not 5. When I get that annual return, I'm going to have to pay taxes on that as whether I take constructive receipt of the contract or not. Now remember, this is where the power of deferral comes in. In my CD rate, even if they were equal, they're not. Annuity rates are generally higher than the bank, but even if they were equal, the power of deferral, deferring my taxes, and the longer I defer it, the better it is, against paying my taxes every year, that really matters in a combination annuity. So when I look at the annual return for 6 years, I'm getting $5,250. That's my return in my tax bracket at 28% marginal income tax bracket. If I look at that number, I'm paying $1,470. Then I say that means that my net return after taxes is $3,780. That's the money I get to spend. That's take-home money. Then I look at it and say monthly return after taxes. If you were looking at it as a monthly idea, then it's about $315. So you're just going to have to determine in your mind, I just paid taxes. What if I didn't need the money, right? If I really didn't money, you could let it run. So what I'm going to do now is I'm going to split this $150,000 and see if I can get a better deal using a combination of two annuities. One is a single premium immediate annuity, and another one is a single premium deferred annuity, and see what I can do on that. So after 6 years, my amount left, the principal, remember we're only taking income, my principal is $150,000. There it is, and it's only guaranteed. Remember, the banks are only guaranteed as good as the guaranteed fund with the FDIC. So when you look at the FDIC, you say, is that a good deal? And remember, ours is only as good as the strength of the carrier. So you're just going to have to determine, is measuring a contract, annuity contract, backed up by a big carrier? And that's why due diligence, that's why ratings and balance sheets sometimes can really matter on this. You want to be able to look at that. So the bank has the government behind it. Ours has the strength of the insurance company. Remember, the insurance companies, some of these have been around for hundreds of years. So you just want to look at the due diligence and do your really good financial due care on these contracts just to make sure that you feel comfortable with the carrier balance sheet. Now, what I've done is I've taken $150,000 and I'm going to split it between the two annuities. I'm going to give them $27,795 at 3.5 into immediate annuity for 6 years. That generates an income of $5,168. Actually, in this example, the bank looks like it wins. But the problem is that 90% of that payout is going to go tax-free because it's actually a return of principal. So I'm going to look at that number. I'm going to have to pay my tax on the portion that is gain, is taxable, and that's $141. Once I pay that out, I have a net number of $5,026 against the bank's $3,780. This is why I'm measuring the actual after-tax, because that's where tax-deferred annuities are. And that's why they use the phrase, they love the front-end preamble to any annuity, tax-deferred. So now I'm looking at this and I'm saying, wow, my monthly after-taxes, if you're doing it by the month, is $315 for the bank, but it's $419. It makes a difference. Just that one little tactic, using the SPIA, single premium immediate annuity, and comparing it to the bank for income. But once I've gone through 6 years, there's nothing left in the single premium immediate annuity. In the bank, I still have my principal. So that's why I need the second annuity, the single premium deferred annuity. That deferred annuity needs to stay in the accumulation mode for 6 years. And so let's look at that. I put in $122,000. Remember, I had $150 total. I took my $27,795, put that in the single premium immediate annuity, and I took the residual $122,025, and I put that in a deferred annuity at that 3.5% rate. When I do that, it takes 6 years at 3.5 to come back to its original principal of $150,000. So during this 6-year snapshot, I'm actually making more money by doing the SPIA combination with the single premium deferred annuity than I am just staying at the bank. The actual payout overall is going to give me about, it looks like here, about $1,200 times 600. So it's significant. It has a bigger piece of the pie that I get to keep. Heads up. Once you do this, though, you say, Steve, wow, that's great. I'd love to do combination annuities and just keep rolling this up. Well, heads up. Now you have gain in this, about $23,000, actually more than that, about $27,000 a gain, or $27,000 $100,000 of gain, so that you're going to have, now you're back to your number, but now if you try to split that again, now that number, I have gain in there. So it doesn't quite, it works great for a one time. There's an idea I'm going to show you here in a second that you can kind of get around that, but really, fundamentally, you can do this scenario one time. Now what I want to do is talk about several combination annuities in a platform, and I'm going to go to the drawing board now on the Mondo pad. Okay, now we're going to draw out kind of a timeline on using several combination annuities. The first one I want to do is I want to draw out a box and say I'm going to use this for income during the first year through the 5th year. That is going to be my single premium immediate annuity. And it's going to generate income, and whatever that income is, that'll be current. And just like I showed you in the single premium example over on the actual, the thing we just used on the chart, I want to show you this income that you're going to generate is going to be current income, and it's going to have some tax advantages to it. Again, remember, why? Because I'm getting a return of principal during that SPIA, single premium immediate annuity. Now, while I'm doing that, I also want to have a single premium deferred annuity accumulating during years 1 through 5, but I'm not going to take constructive receipt of that money till years 6 through 10. Again, there'll be some tax advantages again for this. So I'm using an SPIA for the first 5 years. I'm using an SPDA, single premium deferred annuity, from years 6 through 10 to get to that number. And then in my 10th year, I might be using, because we haven't talked about this week, we're going to use an SPDA index, though. I'm going to use an indexed annuity. And when I use my indexed annuity, I'm going to hold for that period in time, right? And that means I'm going to be taking my income out, depending upon how long I want to do that. I might be taking my income out from years 11 all the way out to my life expectancy. And if I do that, that gives this 10 years to accumulate, and then I can trigger an annuity income or take constructive receipt on it, whatever I want to do. And again, because we're talking about non-qualified, I'm going to have to figure out what the taxable events are. But again, there's going to be some tax advantage here, and I want to be able to look at that and see what it is. And so on my timeline, just kind of go through it to make sure we understand the mechanics. Single premium immediate annuity pays out 5 years of payments, generally on a monthly basis. Then we've exhausted all that money. At the end of that 5th year, I have nothing. No money. Now, then I switch over to my single premium deferred annuity, which has been accumulating over that last 5 years, and I take income out over that next 5 years from years 6 through 10. But after that 10th year, I don't have any money there either. Now I've waited 10 years. This has been deferring for 10 years. And again, tax advantages along the line. Single premium deferred annuity index now. I'm using an indexing. And again, remember, there's a lot of indices for you to choose from. I'm going to hold this. I can go this all the way out, not just to life expectancy. I'm just saying that's what it will go to, whatever your expectation is. But it's really, the phrase is, if you use lifetime income, you can get this kind of idea through this lifetime income that you cannot outlive. Preservation of principal and lifetime income is a hot issue right now. Remember, you're giving up some of that preservation of principal because you're spending down immediately to get immediate income. But for people who are looking for retirement income, this is an excellent use of combination annuities. The first one was just using an immediate and a single premium deferred annuity. This is using 3 different types of annuities, and they're all based on deferral. Now, even with the SPIA getting immediate, I still get tax advantages because what's being returned to me, and so is mostly basis, and I have to look at the math here after my taxable event. And if I'm taking this money during my time where I'm taking Social Security, remember, during this 5 years, very little of this is going to fall on the provisional income test. So you want to look at this, should I do just 2, a combination annuity, or should I start doing 3 or sometimes 4. Some people actually will buy an indexed life contract in the 4th position as an income. That's combination annuities.
This has been an EduTrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance.